Stocks taking off in the first half of the year with President Trump sounding more upbeat on those China trade talks and investors betting the Fed will cut interest rates this month. So will the good times continue to roll or should investors be nervous? Let's ask our market pros. Eddie Gabor's with us, Danielle Shay and Gary B. Smith. Gary B., I don't think anyone thinks we can match the first half of the year, but maybe do we still continue to move higher?
We could move slightly higher, I suppose. Look, it's kind of a dichotomy. One is we've risen almost 27% from the lows very late in 2018. So are we going to tack on another 27%? That'd be the greatest year ever. And that would be in the headwinds of economically, we're kind of a little bit flat, I would say. Retail is flat at best. Manufacturing is flat. About the only thing we have going for us is two-pronged, and they work against each other. The China tariffs going away and the Fed reducing rates. But if China tariffs go away, I think the impetus for the Fed to reduce it more than once kind of goes out the window. So, maybe you get one, maybe you get the other. I'm not sure you're going to get both. Maybe another 5% up for the year.
Danielle, another aspect of all of this, though, is the consumer remains robust, strong, disciplined, spending money when they have to, still saving a lot. And that's an underpinning that probably won't wane.
Yes, that's definitely correct. And I mean, especially there are certain sectors of the stock market that are impacted by consumer spending. If you look at e-commerce, for example, you have stocks like Amazon, Shopify that are continuing to fly. You also have credit card companies, MasterCard, Visa, that are flying sky high. And these stocks are going to remain strong. And if we do get a dip, I'm going to continue to buy them.
Well, we had a dip in May, Eddie. In fact, it was one of the worst Mays in a long time, and then it was followed by one of the best Junes. In fact, the best June in 80 years. So the volatility might be back. And to Gary B's point, it feels like investors from time to time are grappling with the reason for the market to go higher.
Yes, and here's the one thing with the market, which is why I think people can still be bullish for the rest of this year, is there's not that euphoric state at this particular time right now. You're not seeing that euphoric moment with investors. Although I think there's some downside here in the short term because of the Fed. I don't think they're going to reduce rates. The inversion of the yield curve, I think, may have people spooked. But I still believe that buying the dip is going to be the play for 2019, and I believe we will finish higher than where we are right now.
No interest rate cuts at all then for you, right, Eddie?
I'm sorry?
You're saying no rate cuts at all for the rest of the year?
I think at best we get one rate cut in the fourth quarter. I think they're going to disappoint the market in June and not do a rate cut.
All right. Hey, Gary B., we've been talking about these things in the headlines, whether they're tariffs, whether they're China. It's going to be refreshing to get back to an old school market that's sort of relying on earnings and earnings forecasts and things like that. If that is the case in the second half of the year, how does that change the dynamics of all of this?
Well, I think you're right. My God, how long has it been since we just focused on earnings? Since you and I were in grade school, it seems, Charles. But I think it's all going to depend on the China tariffs. Look, I don't think the tariffs, to be honest with you, have that much an effect on our total GDP. I mean, there was an article in the Wall Street Journal the other day that individual companies are negotiating directly with China to get around the tariffs. But that being said, I think that you will see in their outlook that it will improve the bottom line. So if that goes away, I think you're going to see at least slightly better earnings outlooks, and that alone might raise the market. I'm still skeptical if it translates into actual bottom line numbers, though.
Danielle and Eddie both mentioned a dip. They would buy the dip, but Danielle, are you concerned about that would cause that dip in the first place?
So what we've seen over the course of the past few times where the S&P has made new all-time highs, particularly if you look at January 2018, September 2018, and then again in May of 2019, what happens is you just kind of have a petering out of momentum where there's just not enough people left to buy. And then what happens is overnight there's some type of surprise news. You get that first gap down and the selling starts. And so we've seen that pattern a few times, and I have my eye out looking for it. And when it does happen, like the gentleman said, I'm looking to buy.
Eddie, let me say for people who aren't as nimble as you and Danielle, Would it just be worth holding then, since you do expect the market to subsequently rally? And we know if we break out to these levels that Danielle described, get a true breakout, it can really take on a life of its own, couldn't it?
It really can. I mean, it's when you're in these late cycles, I mean, it's not abnormal to see these surges happen. Now, investors out there, I would say if you're overweight equities, depending upon your risk tolerance, it never hurts you to take a little bit off the table when you've had such a fantastic start to the year in anticipation of volatility, and then look the dollar cost average back in, because I do think you may have some possible better entry points at some point in time after we get these next earnings reports.
All right, we'll see. Hey, Eddie, Danielle, and Gary B., we'll talk to you soon. Happy 4th.